What if I told you that your bank is using your trust against you to charge a hidden trust tax that could cost you nearly $300,000? It's an infuriating thought. You're being penalized for the very same trust you placed in them. In a way, the bank trusts you. They trust you to not look too closely at your statements. They trust you not to ask what an MER is. And they trust you not to realize that there are far better, cheaper options out there. As a CPA, I see this every day. Today, I'm going to show you how this tax on your trust really works, how much it's really costing you, and how you can take back control and stop paying it for good. So, what is this trust tax? Well, let me tell you a story that happens every single day in Canada. You've worked hard, you've saved up some money, maybe $5,000, maybe $10,000, and you decide to do the responsible thing. You walk into the bank and you say, I'd like to invest for my future. And your advisor, who is a perfectly nice person, says, Great, we have the perfect solution for you. And they put your money into the bank's very own mutual fund. And it might be called something like the Canadian Balanced Growth Portfolio. It feels safe, it feels professional, it feels easy. And that feeling of ease, that very feeling, is what's going to cost you a fortune. Buried deep in the documents of that fund is what you'll find the management expense ratio, or MER for short. For most Canadian mutual funds, that will average around 2%. And that, my friends, is the trust tax. You don't have to take my word for it. In fact, we're going to use a free public tool right now so you can see the math for yourself. There's a great Canadian website called Learning to FI that has a simple MER calculator, and we're going to use that for our example. So what we're going to do is we're going to plug in some numbers. We're going to do two scenarios. For scenario number one, we'll imagine we're paying zero fees and our initial investment is $10,000 and we're adding $500 into it every single month. We're also going to assume that we earn an average rate of 8%, which is what the market has done over the long haul, and we're going to use that as our growth benchmark. And we're going to see how this investment does over a 30-year period. For scenario two, everything is identical, but what we're going to do is we're going to add in that 2% trust tax and see what the bank's mutual fund is really costing you. All right, let's dive right into the math. So the first is we're going to assume that there is zero fees. You are initially investing $10,000 and you're going to add $500 into it every single month. And let's assume you're making about 8% on average, which is what the stock market has done over the last few years. And we're going to invest for 30 years. So once we run the math, we can see that that 10,000 investment, $500 per month, 8% return for 30 years grows into $854,000. Honestly, this is why I love the math of compounding. A small investment and then adding a little bit to it every single month over the long haul is going to give you the biggest leg up when it comes to world investing. It doesn't have to be complicated. So over 30 years, you make a nearly $1 million. And the cool part is you've only invested $190,000. The rest of that growth of 664,000 has just come from owning a fund that has grown with the market growth. And that's how we got to 854,000. Now, as I said, for scenario two, we're going to do the exact same investment, but we're going to add in that 2% trust tax. Let's see the difference. So let's go ahead and make this $10,000. We're going to invest $500 a month, every single month. The return is 8%, and we're going to invest for 30 years. And let's go ahead and add in that 2% MER. Let's calculate. Well, look at that. Your mutual fund only grew to $562,000. You've invested the same in each scenario, 190,000 in scenario one and 190,000 in scenario two. But look at that difference where one grew to 664,000 because of market. Again, it's the same growth rate, right? 8%, 8%. The only difference is this 2%. And that's the thing. Most people think, oh, it's 2%. How much difference can it really make? But the math is so revealing and shocking. That 2% is costing you $300,000. And that's what I mean by the trust tax. If you don't know any better and the bank puts you into their mutual fund, look at that difference. This is your money. Do you want 562,000 or would you rather have 854,000? That same $300,000 in your pocket can make a massive difference if you're trying to buy a home or using it for a home deposit in many parts of Canada. That $300,000 you can use in retirement rather than going to the bank's profits. And that's why if you realize this earlier on in your investment journey, you can take control. And that very same control is what we're going to talk about next. So how do you stop paying this trust tax and claim nearly $300,000 for yourself? Well, it's surprisingly simple. You stop paying someone 2% for a job that you can do yourself in 15 minutes a year. Instead of buying into the bank's high cost mutual fund, you can open up an online brokerage account right now and invest in something that's called an all in one equity ETF. Now, there are several great Canadian companies that offer these types of ETFs. The two most popular examples you'll hear about constantly are XEQT, and that is their ticker symbol, and that is from iShares, and the other one is VEQT, which is also the ticker symbol, and that is from Vanguard. And these two ETFs, they do the exact same thing as the bank's high cost mutual fund. They invest in thousands of companies worldwide, but instead of paying 2% for that benefit, you're only paying 0.2%. That is a 90% reduction, and that reduction means more money in your pocket. And of course, XEQT and VEQT aren't the only options. There are some other great alternatives out there. For example, ZEQT from BMO or FEQT from Fidelity. In fact, if you want me to do a deep dive in a Battle of the Funds video comparing all these great all-in-one equity ETFs, hit that like button and let me know in the comments section which ETF you're the most curious to learn about. And the most important thing is, irrespective of whether you go with VEQT or XEQT or ZEQT, list goes on, the most important thing is that they all follow the same winning formula, and that is low cost. They invest in a portfolio of global stocks all around the world, all for a fraction of the cost that you would pay the bank's mutual fund. Now, I have to be super clear here, and this is also very important. The letters ETF, it is not a magic formula that means guaranteed low cost investments. There are plenty of complicated ETFs out there, and they promise great things like ultra high income or leverage returns, but the MER for those is shockingly high. In fact, it's actually comparable to those high cost mutual funds. For example, popular income ETFs like HYLD or YTSL have high fees right back up in that 1.5 to 2.5% range. This proves the fundamental rule for every Canadian investor: complexity is expensive. The true secret isn't just pick a random ETF you found on Google search or on Reddit, people talking about high income yield, whatever, max ETFs.
Okay, so what is everyone saying about this new stock? Let me see here. Interesting.
The true secret is buy simple. The beauty of an all-in-one fund like XEQT or VQT is that its strategy is very simple. It passively tracks the entire market. It's not trying to do anything fancy or complicated, and that's precisely why the fees are so low. Look, this isn't about blaming that very nice person at the bank who is just trying to do their job. They're also trying to earn a living. They're working within a system that's designed to profit from complexity and from your trust. In fact, I have many videos on this channel designed to guide you through on how you can actually manage all this yourself, from beginner concepts on how to actually open an investment account, which ETFs to buy that are low cost, how do you actually buy them. All those videos and more I have covered for you on this channel. And you know what the amazing part is? That the alternative to those high cost mutual funds is not only a cheaper product, it's a fundamentally better product. Think about that value you're getting. For a tiny 0.2% fee, you get to own a slice of the world's best nearly 10,000 companies, all held in one neat package for you. That is the power of taking control. You work way too hard for your money. You know this, I know this. And that's why it's time for you to take back control and put nearly $300,000 back into your pocket. Now, if you're feeling fired up and want to learn more about these low-cost, simple ETFs that I've mentioned in this video, I have an entire video dedicated where I break down these ETFs for you. So I'll leave a link in the description below so you can check that video out. That's all for this video. I appreciate you taking the time to watch this. Make sure you hit that like button and that subscribe button. It lets other Canadians who are struggling about their investments find this content right here. It also tells YouTube and me that you want to see more content like this. So please do me a favor. Make sure you don't leave this video without hitting that like button and that subscribe button. That's all for now. I'll talk to you in the comments section.